Happy Wednesday. Welcome to another week of The Educated Homebuyer Live with Mr. Lewis and myself here to update you on the mortgage market, the real estate market, the economy, and have some fun while doing it. So, Josh, what's happened? What's happened over the last week?
Nothing good. Nothing good in the mortgage world. The world is good. Jeb and I are healthy. We are happy. That's the positive. But coming into the office is a little bit of a downer every day. We keep waiting for something to change, and it doesn't. It's Groundhog Day.
Very much so. And we're going to talk about that. We're going to talk about, we've got some positive news on inflation. There's some good things happening out there, but unfortunately it's not reflecting in mortgage rates, which is in turn impacting everything around us. So with that said, we're going to dive into some charts as we always do. Start putting your questions in the chat. Josh is already yawning, so this is not a good sign.
I had my caffeine early today. It's worn off.
So let us know where you're watching from. Josh likes Del Taco, so let us know what your favorite fast food Mexican restaurant is. Doesn't even have to be Del Taco,
bro. After you telling me you didn't like Del Taco, 5 days later
I was in Barstow,
the Barstow Del Taco.
That's
the pinnacle of Del Tacos.
The only restaurant that you could eat at, possibly.
Oh, so they got a Dickie's. They got Tommy's.
Not at 8 in the morning.
Oh, good point.
Fair enough. So anyhow, that's where we're at. The show, I hope, improves from here, but that's where we are for now. Let's take a look. The title of the episode is Mortgage Delinquencies Are Rising, and asking the question, is the housing market in trouble? So let's take a look at some charts, as we always like to do, because it tells a lot of the story. And so, Josh, we do see that mortgage delinquencies are rising. Why don't we explain what mortgage delinquencies are? I think it's important, and then also maybe explain the difference in a foreclosure.
Yeah, so we got three bars: the 30 and 60-day lates, which are just considered delinquent. 90 days is the gold bar, and that's seriously delinquent. And then the foreclosure process means the lender has given up on you bringing it current and feels the only way they're going to get your attention is to file the beginning of the foreclosure proceedings, which can be very different in different parts of the country. Texas, it's very fast. California, it's reasonably fast. Judicial foreclosure states like Florida can take years. So all of those things vary. So that's why the biggest bar is obviously the one there, Jeb, 30 to 60 days late. Means you missed one, maybe two payments.
Sure.
And the lender's probably reaching out, working with you. Hey, what's going on? Did you lose your job? You in the hospital? Something bad happened? What can we do? They'll work with you through that time frame. And most of those never progress to the next stage. When you start getting 90 days late, they're going, okay, we got a problem here. And that the foreclosure process is where they've actually said, hey, we don't think there's going to be a workaround. We're going to actually start foreclosure proceedings.
Good stuff. So as we can see, we start to see a little tick up here, and we'll look at some other charts here as we do it. Josh, I'm looking at the screen. I don't see the arrows on the screen to flip through the charts. Do you see that? I mean, I see it down on the slide itself, down in the thing, but I don't see it.
If you hover over it, they magically pop up.
Oh, I did that, and it's still not doing it. But we're gonna. If I just
Use the
click it,
tiny one
it
below.
works. So there we go. If I just click on it, it seems to work. Go forward. But when we're looking at percent of loan balances that are 90 days delinquent, so seriously delinquent, what we're looking at here, you can see mortgages, HELOCs are at the bottom of this list. Whereas you start to look at auto loans, student loans. Student loans a big one, and credit cards. Student loans. There's obviously a lot going on right there. People haven't had to make payments for the better part of 5-6 years. I talked to the girl that cuts my hair and my barber, and she was saying, I just had to start making these payments. I haven't had to make them. She's told me for almost she said 6 years. So that was prior to the pandemic. I don't know if her numbers are a little bit off, but the reality is a lot of people are getting hit with these. Some people know, some people don't. And because of that, people are behind on those. And then looking at actual foreclosures. So these are foreclosures. These are, proceeded past the 30, 60 days. And the bank is actually saying, hey, we're starting the foreclosure proceedings. And I'm assuming these are actually ones that have been foreclosed, but we got VA. VA is a big one that's happened recently. There've been some changes with the moratoriums and the foreclosure process. And so with that, we've seen a tick up in Q1, Josh, and that's why we've seen that bar kind of jump up a little bit. Still well below pre-pandemic, the craziness of the Great Recession, but quite a bit over the last couple of years.
Like way below it.
Oh, sure, but
it would be interesting to go back and look, like even the 90s. There were a couple of periods in the 90s where those numbers got up. So if you look to the left side, that 2005 is 200 a quarter, which is 800,000 or $1 million a year. Is that normal? Is 100,000 what we were seeing in like 2013, 14, 15? 16, so 400. I'd love to kind of see. There's probably not a normal number. We get recessions. There's an economic cycle, and it impacts what's going on with everyone. But it would be interesting to see a wider view of what could be passed off as normal.
No, good stuff. So the reality is, yes, we've seen a tick up. It's not what the headlines are making it to be. It's something to continue watching, right? If you're in an area that's highly concentrated with FHA loans, with VA loans, probably pay more attention to it. But for the most, areas of the country, still a lot of equity. Banks are going to work with people that are behind on payments. So I don't think this is the story that a lot of people want to believe that it's going to be. But again, we don't know what we don't know for now. So that is something we'll continue to watch. Now, this is something we always watch and we talk about every single week, and that is inventory. So inventory currently sitting at 33% higher than a year ago. Sitting at 756,000 unsold single-family homes. That's up 1.6% over last week, which is essentially 11,000 more homes on the market. So, the story continues to be the same. More and more property on the market, and if history has any way of repeating itself, historically speaking, we don't see that peak until probably sometime in August. Last year, we didn't see it until late in the year, October, November. So you're likely going to see more and more homes continue to come to the market for the foreseeable future. So last week, we're sitting at 744. This week, we're at 756. Our low was back in 2022 at 240,000. And last year, we were sitting somewhere around, 730, 740,000. So we've passed where we were last year. This is the highest that we've been since, I think, 2020. But for all context, active listings back in 2015 were sitting just over 1.1 million. So considerably higher than where they are today. Orange County up 2.22% week over week, now sitting at 4,462 homes. Huntington Beach is actually down just over 2.5% at 279 homes. Now, again, I think that tick down in Huntington is just a little anomaly. I think you probably see inventory continue to rise. But we'll continue to watch it and update you guys. I mean, I myself have a couple properties coming up here and in Orange County, so I do know there's more and more active listings going to hit the market, which is going to take those numbers higher. New listings this past week, we saw, I think, 80,000 new unsold listings, 15,000 immediate sales that happened. So 95,000 listings or so came to the market last week. And then taking a look at home sales for May, what is it? 74,000 single family homes went into contract. That's up about 4.5% week over week. So a little bit more activity on that front. Year over year, up 2.6%. Now, I think what's important is last year interest rates were in the sevens, Josh, or so. So we're lower than we were last week. And while it might not feel like a hot market by any means, the fact is still a little bit more activity than we saw the same time last year. Anything you want to add?
It escaped me. It came and it went. It came and it went.
That's fair. That's fair. I would go back, but I don't see the button on the screen to go back. So we're just gonna keep on pressing forward.
It obviously was not a brilliant insight.
Home prices dip below 2024. Josh loves this chart. So median price of weekly pending home sales. So sitting at 399,900. Week over week, we're flat. Year over year, we're slightly below 2024 for the second week in a row. He goes on to say that home prices are flat year over year with rising inventory and soft demand. Downside price risk continues to grow.
Again, keeping with the theme of Jeb, this being my favorite chart, why would he headline it, home prices dip below 2024, when it appears as though those lines for 24 and 25 are right on top of each other?
Yeah,
last week was the week he should have said
that. Maybe he's looking at last week's data. And then price cuts sitting at 36.8%. So it's pretty flat week over week. I think it's up like 0.1, 0.2%, but nothing crazy there. And then something we talk about every so often, but something to pay attention to, mortgage spreads. Mortgage spreads were, trending down for a while, and now we're getting back up to some of the levels that we saw in 2025, still under 2.5%. But one of the reasons that we saw interest rates at 8% is because the mortgage spreads were so high at that time, sitting close to 3%. So if mortgage spreads can improve and we can get the 10-year down, that means we're likely to see lower mortgage rates, which at the moment, Josh, is not happening.
So Jeb, since I've been distressed by most of the recent news and the market's reaction to it, we have a potpourri. We have a grab bag of data here. So a poll from Gallup shows that while we've seen these recent consumer sentiment surveys that now is a terrible time to buy a house or people are frustrated by affordability, still shows that long haul, which of the following do you think is the best long-term investment? Real estate is the tops of the options they gave you. Real estate, gold, stocks, mutual funds, savings accounts, bonds, crypto. Crypto is a new one there. Only the millennials and the Gen Z care about crypto. Old people like Jeb are not interested.
Well, how do you fall into the millennial and Gen Z category?
I identify as a millennial. Can't you see it on my face, Jeb? I identify as a millennial.
That is it. That is exactly what I see you as.
Thought this was an interesting one here. Again, we talk about homeowners' net worth being 40 times greater than renters, but total assets of U.S. consumers, 27% of that is in home equity, 43% in other financial assets. So remembering that renter is really the other financial assets. Well, deposits are going to be that 8%, but over time, it's skewed by the ultra wealthy, these other financial assets for the average median American. Let's not call them average. There are no Americans that are average. For the median American, it's about 50% of their net worth is in home equity. This, Jeb, tells us a lot about that sentiment of what consumers are seeing. We are seeing, again, home payments up 2.5% year over year. You just talked about interest rates are down a little bit year over year, but home prices are up. So you're still seeing slightly higher prices. If we see a cross where this starts coming down year over year, which could absolutely happen, but it will require a movement in lower interest rates. That will put some support and demand into the market. Jeb, we talked about this on today's podcast. Median age of first-time home buyers is 38. And as I'm hearing that, I'm like, a lot of buyers that are younger than that. So I thought this chart
we have
here,
one right now that's
24,
24 years old. Yeah.
And married. That's amazing. Married, buying a house, got a career. They got everything going on. Youngsters doing things. That's why I identify as a millennial, but they may even be Gen Z. Is a 24, for you guys that know, is a 24-year-old Gen Z?
I think
They
have to. They have to. They have to be.
Yeah. I lost track. I lost track of all this. But what I thought here, this is first-time home buyers in each age group. 71% are 26 to 34, but it's just that median. When you add in all the 35 to 44-year-olds, 36%, 45 to 59, 20%. When you add those all up, it skews the median up. But if you're trying to figure out where you fit in on that, I would say anywhere from late 20s to late 30s is the majority of first-time buyers. So Jeb, you hinted at this. We had some inflation data this week. The market didn't seem to care that inflation beat expectations, was lower than what people thought. So what we had, the green boxes there, I want to show you guys how this works. We came in at 0.2. We had a 0.3 fall off. So the annualized number was lower by 0.1%, and it beat expectations because the expectations were we were going to be basically at 0.3. So these numbers get rounded. It's not a huge difference, but I wanted to highlight for May and June, we're going to have some headwinds here because we got a 0 falling off for each of the next months. So when you see the headline next month that says inflation ticks back up, unless it ticks up more than expected, that's not due to tariffs. That's not due to inflation kicking back in. It's due to we had 2 really good months last year. So this is the Cleveland Fed's nowcast. They're expecting 0.11 month over month for May. So if we lose the 0 and we add a 0.1, it's going to tick up. Core PCE and core CPI are both at 0.23 and 0.21. So it's great. We look at that relative to 2023 when those figures were at 0.4 and 0.5 and 0.6 month over month. It's a great improvement, but we need to be at 0.17 or lower month over month to hit the Fed's stated goal of 2% on the core. So when we're looking at these, definitely better. We've seen improvement in the right direction, but obviously not where we need to be. Trueflation, I like to throw that green trend line on there. We're still well below 2% with Trueflation, and the biggest difference there is they are capturing real time what's happening in rents. I didn't find the chart, Jeb, but I think the Apartment Owners Association came out and we're actually seeing negative rents year over year due to apartments. So not single family homes, but apartment rents down nationwide. Your mileage may vary in your local market, but as that data continues to come in, absent tariff-related increases in prices elsewhere, you're going to see inflation continue to moderate towards that 2%. So again, I love consumer inflation expectations. This is from the New York Fed does this. The University of Michigan also does it every month. But 1 year inflation expectations, consumers think we're going to be at 3.7, almost 3.8%. We just showed you the numbers at least 1% lower than that and trending down, but consumers' opinions have been here trending up. 3 years, they think 3.1%. Over 5 years, they see it trending down to about 2.8%, but we're already below that. So it's important. What goes into this, it's what consumers are seeing. So when eggs shoot up, they think inflation is terrible. When gas prices shoot up, they think inflation is terrible. When the media is hammering on different things being expensive or the potential for inflation coming from tariffs, just important to know where that's coming. Thought this was interesting, Jeb. So on Monday, bond yields were up, interest rates, mortgage rates were up, and that was largely on the announcement of the deal. We came in with the deal with China. So on February 1, we had 10% tariffs on all goods. And then we first announced we're taking that to 20%. And then it went to 54 and 104, 145%. So we are now down to 30%. And that sounds great until you realize it's 3x where we were at the beginning of the year. And on many goods that come from China, that is still going to be a serious break on the economy for what is affected by that. So it will be interesting to see what happens. Because again, all we got was another 90 days to negotiate what the end run real number looks like. And we joke because it's kind of silly looking at charts like this, but it's very serious, deadly serious that China does manipulate markets. They manipulate their currency. They do dump goods in other parts of the country. So they are not a good trading partner. We need to be having serious negotiations with them. I'm just not positive this is the right way to do it, Jeb. We talk about
that.
We talk about affordability and the three legs of the stool with affordability: home prices, interest rates, and wages. No one ever feels like they're making enough. This is real. So inflation adjusted using PCE, real median wages from 1961 to 2023. And what you can see is we have these waves where they run up and then they stagnate. We don't ever really see them come down, even in real terms, but run up, stagnate, run up, stagnate, run up. We're at the end of a run up here. So we may be entering or looking at a period of flat wages on a real basis. You're going to get your cost of living raises, but we'll see what happens with inflation, and we'll see how tight things remain.
You know what I like about this chart, Josh, is when you look at that second yellow bar there, the arrow rather, that's 2010-ish, somewhere in that ballpark. So approximately 15 years ago. You know, a lot of the people that benefited the most in home ownership in that wealth gain during the pandemic were people that bought, you know, in those early teen years, 2010, 11, 12, 13. I mean, I was one of those, fortunately. But what happened was not only did my wages, in theory, increase, right? I mean, you can see it here. Real wages are increasing, but home equity increased. Stock market, like there was a big gain for a lot of people. So when people say, who's buying these houses? How are they doing it? The people that owned assets were the people that benefited the most. Now, it sucks for those that didn't, but that's the longer term time horizon that we're often talking about. It's like you can't look 1 to 2 years. You have to be looking 10, 15, 20 years down the road with a lot of this stuff. So anyway.
So back to the depressing stuff, Jeb. Here is our wonderful chart. You'll notice our up channel, our down channel, our trending sideways channel. We erased them. They're all gone because what we've seen is just chaos. This is much longer, going back to the early part of 2023. And you can see we have a wedge forming. So each successive high has been lower, but we're near the high of that descending trend line. It is important that we hold in this range. I'm hopeful that we do, but I'm not going to hold my breath either. If we do, it's likely that we'll move to the bottom of this range, but you're seeing higher lows, which is not good. We want to see lower lows. It's telling us that we're reaching new, better levels. At some point, there will be a breakout one way or the other in one direction. So we will see what that looks like. Hat tip to Jeb for properly drawing our wedge earlier today. What does it mean for you in real terms? Holding on by the skin of our teeth below 7% on 30-year mortgages and mid-6s on FHA and VA for well-qualified borrowers. People with lower credit scores are going to be worse. The best qualified borrowers are going to be a little bit better than that. But that's all we got this week, Jeb.
Yeah, and if you're somebody out there that has a higher rate, you're waiting for rates to come down, you're tired of watching it every day, beating your head against the wall, want us to do it for you, you can go to jebsmith.net/rate watch. Get on that list. As rates come down, we'll definitely be in touch. Right now, not a lot to report, but you know, we're monitoring it every day so that you guys basically don't have to. So with that said, if Josh or myself could be of any interest to you at all, if you're going through the pre-approval process, you have questions, anything like that, you can get in touch with either of us using that referral link scrolling at the bottom of the screen there, jebsmith.net/start, so that you can start the process.
Jeb, you said if we could be of any interest to them, that implies that if they find us interesting, they can call and we will amuse them instead of service.
It could be amusing.
Of service to them. Hopefully we would amuse you if you called.
We can definitely amuse you. Yes.
All right.
Okay. So Jeb Smith sounds like someone who came over on the Mayflower. You know, Jeb Smith, well, not Jeb Smith, Jeb Stewart was in the civil, I can't say that word, civil war. And because I was born in Tennessee and raised in North Carolina, my parents thought it'd be a good idea to name me after somebody that was, you know, fighting during that period of time. So that's where my name came from. We're a bunch of rednecks, unfortunately.
You are a Confederate soldier, is what you're saying?
I am not.
You said you fought in the Civil War, and then I said you were a soldier instead of a soldier. We're having problems speaking
Yeah,
today.
exactly. But yeah, that's the rednecks in my place. That's what they do. They name you weird things, and that's unfortunately where
And then
we're
have
at.
you go by entirely different names.
Yeah, exactly. So we've got some comments here. We got Heather in Inglewood. Heather's always a regular on here. Heather mentioned that she likes street tacos, El Pollo Loco, and Waba Grill. She throws in Panda Express, which we know Josh likes.
Panda
But here's
Express
the
is the
deal.
worst thing you could ever eat, but it is a guilty pleasure.
It's I haven't eaten there in a very long time, but I recall it being fantastic. My son loves it. I know you're not in Compton, you're in Inglewood, not that far away. There's a fantastic barbecue spot that it keeps coming up on my Instagram that I'm going to frequent here. I don't know when.
How do you know it's fantastic if you've never been?
Because I asked a client and my client's been there, and then we were supposed to meet to go there, and then I was going out of town. So it's going to happen, but I
Have
don't
you
know.
been to
Just
the
if
new
you
one
like
in Costa
barbecue.
Mesa?
I haven't. I've heard that the food's good, the service is awful. So, but
Problematic.
that was when they first
Did
opened. So
Did you
perhaps it's
know we
better.
have heritage now at Sea Legs
I
at the
did.
Beach?
I did know that. Yes,
We got to do because you do the news. Because you do the news on Instagram. Did you
I
do
do.
a post on that?
I
That would
did
get a lot
actually.
of views.
I
People want to
actually
know
did.
where heritage is available.
I actually did. Yes, I did. Okay, so we're moving along here, guys. We are providing zero value to it at the moment. Baja Fresh, Drew says, I didn't even know those
I
were
didn't
still
know there
around.
were any left. There used to be one right across the street that's been a Chipotle for the better part of a decade. And then where our place in the desert, there was one right across the street at the river that has been like some weird local place for a long time.
Yeah, there we go. Like it's been a while. We got it. We even have a Little Rock in here, a Little Rock, Arkansas. Let's see. So Josh, you got people.
Heather wants to know, is it Woody's Barbecue? Is that what you're talking about? Is that where you're going?
Yeah, I don't know. I'll have to look. I don't remember the name. But yeah, I don't know. But I'll write that one down too, because I'll go there too. I'll do
I'll go to
both
all
on the
of them.
same
I will
day.
eat barbecue 8
Be
days a
like
week.
Guy Fieri, and I'll just go to both.
Lewis
Like, right
Barbecue in Charleston, South Carolina is the greatest barbecue in the country. And it's not Carolina barbecue, it's Texas barbecue in Carolina.
That just means you put a lot of sauce on it, Josh.
It's delicious.
Anyhow, let's go with this. Julieth has to lock a rate Friday. Should they lock tomorrow, Thursday? Tomorrow is Thursday. Oh, tomorrow, Thursday. Or
last
wait
Friday
until
was the
Friday.
correct answer.
Last Friday. So what would you do, Josh, if you were locking? Is there anything that's happening this week with data that big movers?
Well,
Shakers
go
outside of
back.
CPI?
There is a ton of data coming out tomorrow. PPI and some other crap. None of them are like top tier, but two or three important ones, including PPI. I'm a little bit of a dice roller. I don't think there's a huge risk like they're going to shoot to the moon tomorrow. So since you've already got the worst of the run up over the last week, I would possibly see if the top of that falling trend line there holds in that wedge. Maybe we get PPI a little bit lower than expected. Maybe we give back some of the monster gains that stocks have experienced over the last 2 or 3 weeks because magically everything is fixed now. But be aware that there is definitely some risk tomorrow. The market has shaken off all of the recent good news, positive news for bonds, and just basically ignored it, and rates keep going up. The best explanation that anyone's come up with, Matt Graham over at MBS Live, basically the rotation into stocks. Normally, in a normal market, stocks and bonds compete. When stocks are doing well, bonds are not doing as well. That's as good an explanation as anyone can come up with. So if you told me you want to lock it right now, I wouldn't argue with you. If you have a little bit of a risk tolerance, because there is some risk tomorrow, might wait till Friday. If we don't get it better tomorrow, there's nothing coming Friday going to save you.
Yeah, unfortunately, I see the chart moving up to 4.7-ish on that 10-year before we see any meaningful
Jeb's
move
out
down.
Of his mind. We're not going to see 4.7. Jeb's crazy.
We'll I could be crazy, but that's me looking at that chart. Rue from Burke, Virginia, is also here in the house, so good to see you. And then we got Pop Keys finally catching alive. So thank you for being here. All right, Mr. Lewis, I saw a question that had to do with where was it? I don't.
The Willing's question?
Perhaps it was Willing's question.
So
there it is. There you go.
How can borrowers use rental income? And it's more specific than that. If, for example, they've only had a house for 4 months and they don't have tax returns, are you limited to only using tax returns? The borrower has many investment properties. So no, if you bought 4 months ago, it was January of this year, even if you bought in December, it wouldn't show up on a tax return. You wouldn't catch enough rents and expenses there for it to make sense. So just like when you're purchasing the property, we can use 75% of the rents per the lease. Now, since we don't have any record of it, they're probably going to ask you. They're going to want you, your underwriter's going to want you to document. I want to see the executed lease. I want to see that you received the deposit. I want to see the rents over the last 3 months. Very, very common that you need to do that. We just closed one, Jeb, yesterday for a listener that he had a property that they had a problem with tenants during COVID, finally got them out about 18 months ago, did a full renovation on the property, and they just got tenants back in the property. We were able to use the lease with the explanation of what that vacancy was, but we did have to prove 3 months of receipt that it not only was it rented, but we have a security deposit and we've been receiving the rents for 3 months. And then they did a market rent survey to confirm that we didn't just make up some crazy random number. So yes, you don't need it to be on your tax returns to actually be able to use it to qualify.
All right, good stuff. Sean has been listening to our podcast for a couple years. Just closed on their first home. I don't know. I'm going with male on this, but that could be wrong. Closed on my first home last week in Buffalo after 7 unsuccessful offers. Locked in my rate at the end of March at 5.87. So congrats to you, Sean. I'm glad we played maybe a small part in that process. So appreciate you listening, paying attention to the podcast. So speaking of the podcast, we recorded the webinar for first-time home buyers back in January and then again in April. And then in April, it was a little more updated because we asked your feedback and we put that stuff into the webinar. We were going to hold off on doing the webinar, but we decided to post it on the podcast and on the YouTube channel at The Educated Home Buyer to just give you guys that information so that you don't have to come and watch a live webinar to watch that information. It's long. It's over an hour, but it literally takes you through the entire process of buying a home, come from a bird's eye view, right? There's some details in there that need to be worked through depending on your situation, what you're trying to accomplish, but it's a really good episode. I would suggest taking a look at it. If you're in the home buying process, you're not real sure about it, go listen to that, go watch it. And then if you know somebody that's going through that process, the best thing you can do for us, if there's, we ask any favors, it's to share it with somebody, right? And hopefully they provide some value or they find value in it as well. So that moves us on to Alfredo. Josh, he's got a house that is valued at $260 and pays taxes on that. Wants to know if I buy and sell for $400,000 for 2025, I'll pay on what? So I'm assuming he's asking
So
about capital
if the
gains.
value goes up, so he buys it at 260. I think he's asking property taxes have valued at 260 and pay taxes on that. And if I buy and it's selling for 400, I'll pay on what? So
Okay.
Alfredo,
I think you're right.
clarify for us. Are you asking about your property taxes or are you asking about selling? So Jeb's right. If you were selling it, that's 140,000 of gain. You have a $250,000 gains exemption if you've lived in it for 2 of the last 5 years. But if we're talking, he says, yeah, we're talking about property taxes. So if it goes up, the property taxes is going to depend on where you are at. Every state handles this differently. If you were in California goes and you are limited to 2% annual increases in the valuation per Prop 13. I just learned, Jeb, through a very unfortunate article I read this morning, that Florida has a similar protection that you can only have a 3% increase annually. And what this is meant to protect is someone buying their home 50 years ago and paying it off and they can afford it, and now home values go through the roof. What happened with these people, Jeb, for us here in Huntington Beach, for most of California, if you leave a wall up, it's a remodel and you're only going to get reassessed on additional square footage, that type of stuff. Well, these folks had a home in a very nice area and they tore it down and left a wall, but it was considered a full rebuild and they called it a new home, and they went from $14,000 a year taxes to $90,000 a year.
Holy
cow. On their new home. So they are not going to be able to continue owning their home, even though it is beautiful and wonderful now that they've done their nice renovations.
What's the math on that? That's what, $7,000 a month, your property taxes?
Yeah.
No, a little less, 6,000. Yeah, 6,000-7,000.
So they got their dream home built right in time for retirement on the intercoastal there in Florida. And the authorities say, hey, we understand what you're saying and we believe you're right. You should have only been reassessed on the added square footage in theory, but the way you did it, this is the way the law reads, and we don't have any flexibility. We have to go with what the law says. But this doesn't have anything to do with Alfredo. So Alfredo, there's Florida, there's California. Most states don't have those protections. So you will get reassessed every year, and somewhere near what the market value is. But not all states do it the same. Like Arizona, there's an assessment factor. They give you the valuation and then they apply a factor that's a portion. So really difficult question to answer in this type of forum without knowing where you are at. You would be looking most likely at some type of increase to your taxes, but hopefully not all the way to the 400. Nebraska. I'll do some research on Nebraska, maybe while Jeb's answering another question, see if I can help.
There you go. Miguel from North Carolina just locked in late last week at 7.5%. Crying emoji face, I think it is, for a land home package manufactured home. Should I worry about that interest rate? It's what I could purchase at the moment. Should you worry about the interest rate? I don't think there's any reason to worry. If that's what you can purchase and you're comfortable with the payment that's associated with that rate, then it is what it is. There's not really a lot of alternatives when it comes to manufactured homes and the lenders that do them. You're somewhat limited, right? It's not as easy as working with a broker like Josh, who can just go out and shop it amongst 50 banks. You're literally looking at a handful of lenders that actually do these sort of things. And traditionally what you find is the rates are a little bit higher. Guidelines are a little bit more strict, that sort of thing, just because they can be in what they're looking to do. So I don't think there's anything to worry about, but understand, just like anything else, if and when interest rates go down, those should go down as well. And you should be able to take advantage of that.
Jeb, we're about to enter the fun fact portion of the episode.
All right, let's hear it.
At 1.54%, Nebraska has the 9th highest effective property tax rate in the United States. So, and it is based off of the valuation. The assessed value is determined annually by your county assessor as of January 1st. For residential commercial properties, the value is typically set at or near 100% of the property's actual market value. So yeah, if it went up 160,000 and you're somewhere near that, or we would say 140,000 and it went up somewhere near that 1.5%, you're looking at another $2,100 a year in property taxes. So you're starting to see how this can impact people in places where home values have gone up, or they bought at a big discount and they're like, hey, this is great.
Until it's not.
Until it isn't.
Until it's not. All right. We've got to that portion of the show, Josh, where there are no new questions. So if you have a question, now is the time to put it in. And while you're doing that, I'll let you know that Josh is not going to be here next week. So I'm going to ask you guys a question that are here. There's 86 or USO viewing at the moment. Who would you like for me to have on the show? Is there a YouTuber out there that you like, that you would like to sit in and have a conversation with myself next week? If so, I will reach out to them and ask and have somebody fill the shoes of Mr. Lewis.
I've narrowed it down to two people who I would like to sit in my seat, either Mr. Beast or Dave Ramsey. I think those are the only two people that can do it.
Dave's 3 hours ahead. He's in Nashville. I'm not sure he's available. Mr. Beast, probably. He was here recently.
I said Mr. Beast.
See, there you go. He was here in Anaheim last week. He was at the Angels game, and I could have gotten him then. I missed him, but no. In all reality, is there anyone out there that you would like to see housing related? I guess they don't even have to be housing related. We'll just get anybody on here. We'll go to the bottom of the barrel if we have to. Name the worst YouTuber YouTuber.
I know the bottom of the barrel. Well, Rich says bring it back with Lance Lambert. Let's reach out to Lance, see if he wants to sit in with you.
I could do that. I could see if he's available, and we can have a conversation there. And anybody else, let me know. And we'll go through it. And Logan lives in Irvine. Logan does live in Irvine. Logan would be a good a guy to have on here. We'll talk about it off air, but I was thinking, if there was a way to do an event, Josh, and perhaps have Lance there to speak, I think could be.
We've talked many times about doing the live event, which we could do over in Costa Mesa, over by the airport. We got a great location for it, so it would be a good option.
Yeah, you guys are naming people like that just have followings that aren't willing to come on here.
We got a suggestion for Meet Kevin. Does Meet Kevin even make YouTube videos
He does,
anymore?
but he's changed everything. His style's changed, thumbnails changed. I think he got super burnt out on everything and just went like completely rogue and just it didn't care anymore.
We got someone said clear value tax. I like the clear value
Yeah,
tax guy.
he's
We
a
got
good
some
dude.
sane
Yeah.
people you guys are
Yeah.
mentioning.
Yeah, so we'll see. We'll see what we can come up with after looking at that. And in the meantime, if there's anyone else, let us know too. So in the meantime, we got Juan. Juan, I hit that and then I disappeared here. Josh, can you see it there? Juan's.
I got it.
There you go. Juan from Connecticut. We sold our primary home in January of 24, moved back into our first home, which we had rented. How long do we have to wait before selling our current home to avoid capital gains tax? So you have had to like the home that you your current home that you're moved back into, if you've lived in it 2 of the last 5 years. So say you lived in it a year and then you moved out and lived in your primary for 3 and now you're back in that house for a year because it was January to January, then in theory you've 2 of the last 5, you could do that. So but at the moment, you've been in there since January of 2024. So what, 16 months? So in theory, if that wasn't the case, you need about 18 more months, 18 more months. And then you will have that 2 years and you can sell it and reap the rewards of the capital gains exemption assuming you have it. So hopefully that's helpful. If that was confusing, let me know when you moved out of the other one and we can help you narrow that down. But you can only get the capital gains exemption every 2 years. So just so you know. So even if you had lived in a home for a year, for example, and then you moved out and lived in a primary for 3 and you sold that and now you moved back into the other one for a year, you couldn't sell that one in a year and also get the capital gains exemption. It can only be done every 2 years. At least that's my understanding. So
I talked to a listener yesterday, Jeb, that he's got the best deal of all. He builds homes, and what he does is he builds himself a new home. They move into it, live in it every 2 years. He sells it, takes his gains tax free, moves another one. He's got $1 million house free and clear through doing this.
Not a bad deal. I used to always, when they originally built these houses here on Yorktown, these monstrosities around the corner, I thought, what a terrible deal. Like, look at these things. And now when I look at it from an aerial view and I see the size of those and everything else, I think, that guy, the builder in there bought the one in the back corner. I'm like, probably a pretty good deal for that
Oh,
too.
the super ultra gigantic ones over here?
Yeah, right off of a Yorktown. Yeah.
Yeah.
Right. I'm like, holy cow. But
Crazy.
he bought at the right time and probably gonna end up just fine on that one. Right. Raul. I live in the States. Rahul. I live in the States right now. Do I still have to have an EIN or a TIN to give it to a property management company once I get back into the country? I already have a Social Security number and US bank accounts.
I'm not even understanding the question.
So the fact that you have a Social Security number
to my country, so he's leaving to another country. He says he's in the States right now, and he's talking about going back to my country. So I'm not sure what we have. Yeah, if you have your Social Security number and U.S. bank accounts, you're golden here. I don't know anything about what goes on back in other countries.
No, nor do
We've
I.
talked about
I
this.
think
I don't leave the
your
48
social's not going to
United
work in other
States.
countries. I don't think. So yeah.
And Rahul, he followed up with yes, but I'm not sure. Yes to what? Yes to going back to your country. I don't have any insights into what we need to do outside of the U.S.
And what country are you going to? Let us know. Maybe we want to follow you. Maybe we'll go with you.
I just told you I don't leave the 48 contiguous United States.
Josh does not. Well, you did. You went to Mexico.
That is true. It's Baja California. I call it California.
That's fair, but
I say
the government does not call it that. So we're going to go with what the government says. Do you see home prices declining in Lakewood, California? I don't know that I see them declining. I see them probably flattening, stabilizing more so than anything else. But what I'll say is that Lakewood has been one of those spots that has kind of been the home to a lot of people that have been pushed out of other surrounding areas because of affordability. So like if you can't afford in Orange County, and you're in North Orange County, say Huntington Beach, Garden Grove, Westminster, some of these areas where housing is more expensive, I have clients that have decided to go up into Long Beach, into the Lakewood area, because it is more affordable and the drive is still relatively close. So, I think that from an affordability standpoint, it is still a pretty good value for where home prices are, for where homes are selling, especially with lot sizes, because a lot of those properties have decent sized lots. So as long as that continues, I think that prices remain stable there. I don't see any reason for a decline at the moment, right? I don't see inventory growing at such a rapid pace or buyer demand backing off so much that there's a decline. But I do see a market that if what we have right now continues, you see a flattening and, more so just kind of a lackluster market, if you will.
Being from North Carolina, Jeb, this is going to mean absolutely nothing to you, but we've talked about it on the show. I told Wesley before, I grew up in Linwood, so it wasn't moving down to Lakewood like you were aspired to. That was the pinnacle. If you could get to Lakewood or Cerritos, you had done it. When we got to go to our friend's house that lived in Cerritos or Lakewood, you're like, these people are upscale. These people are upscale. So you get a different view coming from North Carolina to Orange County.
No, good. Yeah, I feel you. I feel you. Rahul follows up and says, Rahul, rather, if I give all my properties to a property management company and move back to India, can I still legally manage them? Yeah, they don't have to know where you've gone. Those are your properties. You manage them how you see fit. Now, understand if you do decide to file taxes here in the United States, then obviously you're going to have to, use your Social Security number and all that stuff that we talked about earlier. But from a management standpoint, you can manage those properties anywhere in the world. I don't know how you can do that successfully. I mean, if you're giving them to a property management company, they should be the one managing them. But you could still receive the income and all of that stuff. There shouldn't be any issue there.
And because it's the income is generated here in the U.S., you're probably consult a tax expert. Jeb and I just play one on the internet, but you're probably going to need to file a U.S. tax return. But you have your social, so you're fine.
Yeah, exactly. We do not. We are not accountants.
We are not tax preparers. Not in tax season. Not in other parts of the year. I see lots of tax returns. I know what goes on them, and we can direct you to an expert who can give you the correct answer.
Josh, you just said, well, actually, this is me, I guess.
Me again.
If I don't pay my credit cards, can they go after my houses? Paid my credit card, just wondering. No, they're not going to go after your house because you didn't pay your credit card. So you're good on that front, but like Wesley said, pay your credit cards.
But let's just turn the show over to Wesley. He's going to give the sage advice. Right? Pay your credit cards.
It's good advice.
It's unsecured debt. So the reason why credit card interest rates are spectacularly high, there's two reasons for that. The first and most important is because it's unsecured. There's nothing for them to go after. You can do exactly what you just suggested.
Your credit score. That's it.
Stop making my payments. So they can sue you and they can force you to file bankruptcy, but they can't come after anything you own because it's not secured by that. The secondary piece that's also interesting, Jeb, the wizards in the government decided that it was unfair the way they were looking at different people and having different interest rates for the credit cards. So what the credit card companies did is they just raised the rates on everyone. So we all pay high rates. If you have a 900 credit score and $1 billion in the bank, you don't get a lower rate than other folks now. So we all get to pay more.
Yeah, don't worry about those usury laws. We don't have. Well, we're doing it to everyone. It's not usury when everybody has to do it.
I wanted to make sure that Wesley knows that me thanks him. Me thanks you.
There you go. Thanks, Wesley. Yeah, I just told him myself. All right. We are 48 minutes into the episode. If you found any value so far, do us a favor, hit that thumbs up. There is a little ticker scrolling the bottom of the screen. If you're, going through the process now, you're looking for another quote, trying to get pre-approved, want to see what that process looks like, you can go to jebsmith.net/start. If you need an expert real estate agent, I referred 3 different people this week to agents across the country in other markets. 2 of them are already under contract. The third one will be, I'm selling our house in Temecula, and she's going to buy something back up in that Portland area. So she will be in contract as well. So if you need an agent anywhere in the country, let me know. Happy to put you in touch with somebody that does business like I do. It can guide you through that process. That same link, jebsmith.net/start, will get you in touch with me as well, and we can make that connection. All right, Josh, we have once again just flown through.
It's an early end of the night. We answered all of the questions.
We did. except for M. Cano. Bought a house this past summer. Wow, I just almost just threw up in my mouth, and that's probably too much information.
Yes, that's TMI, and we noticed.
Here's the
We saw
deal.
and noticed.
Prior to coming on the show, I told Josh, not feeling well, not feeling great over here, and yeah, that's a testament to that. But anyhow, bought a house this past summer, just had a baby as well. Friends are recommending a living trust. Thoughts? I like it. I think the idea of having a living trust is a good idea. I like the idea of having, if you're not willing to go through the trust process, having some sort of will, a healthcare directive. All of those things I think are important. It's things that we think we'll never need in life until you do. And so I think they're really important to set up. Here in the state of California, I don't know if you know this, Josh, but as of, I don't know if the date's already happened or if it's getting ready to happen, but if your home is less than $750,000 in value, it will no longer go to probate. It is something that I guess avoids probate to some degree. 750,000 is not a lot of money, but it's a step in the right direction.
I believe there's 9 states now that will allow you to do a transfer on death deed. My mom owns a duplex in Indianapolis, and she's getting it redone there. She wanted to add me to title, and I go, "Oh no, you run someone over or you do something crazy, then I'm liable. They come after me too." So let's do that transfer on death deed. So just like a bank account in these states that have the transfer on death deed, assuming it's filled out properly, if the other, you don't have ownership rights, but if the owner passes away, you immediately become the owner without having to go through probate. So also a good tool that's a little bit cheaper.
Yeah, but I like the idea of a trust. There's many benefits of a trust, especially when passing that on to your heirs or something happens and they get the stepped up basis, and there's benefits there. Talk to a trust attorney, talk to somebody that knows the process, but having kids, having a spouse or whatever your situation is, I think it's worth the, whatever the cost is. Tom says, thanks for the max purchase price calculator. It helped me feel more comfortable about my home purchase decisions. Any thoughts about a potential glut of 55 plus properties on us as us boomers depart, rather? Josh, I don't know about your max purchase price calculator. Did you put one out there? Is that something?
We've got tools. We got tools in different places. We'll see where Tom Collins found this.
That was like a very Trump state. We've got tools.
It's the greatest max purchase price calculator.
But anyway, do we have a thought about potential glut of 55 properties? I do not foresee a world in which there's a potential glut of 55 and older properties. 55 and older communities are becoming 55 is not even that old anymore, to be completely. I mean, it's not old at all, really, compared to what it was 20, 30 years ago. And so I think there's a lot of people now that are early 55, that 60 age that are moving into these communities. A lot of those communities now are, people are moving in them for different reasons than they did previously. As boomers age, you've got a couple of things happening, right? Yes, there will be some properties that get passed along to family members. And many of those aren't going to be in 55 and older communities. They're just going to be existing home structures in various communities. And some of those properties will get resold on the market. Some of those properties the kids will move into because they could never afford a home to begin with. And just different things will happen to those. As far as the 55 and older type communities, I feel like the demand for those communities is there because you always have people turning 55 and older, right? There's still a big demographic that is at that transition age. The older part of the boomer age, the 70 to 80 years old, I think the average age of death right now is like 80 or somewhere in that ballpark, Josh. As you get closer to that, I think there's more of a concern for that sort of thing. But at the moment, it's not something that's on my radar. Like, hey, watch out. I think a bunch of this stuff's coming.
Well, a couple things here. Like you said, if we have the charts, and it's funny, for something else I was doing, I had the charts of the generations and the cohort sizes going forward. The biggest thing is we have people sort of backing up at old age. Tom says, talking about boomers departing, they're departing at slower rates, living longer, healthier, aging in place more. So is that everyone? No, it's not everyone. But what we're seeing is there's been an expectation that these folks were going to be selling their homes, downsizing, going to retirement homes, moving to cruise ships, whatever. And it's just not happening at that rate. So plenty of aging people aging in behind them. There will be an increase of some of these homes. So what I would say is there will kind of be some opportunities. A lot of these folks are in nicer communities, but in homes that are older with some deferred maintenance. We unfortunately, Jeb, if you come into my house, when you take that right, the first 5 houses on the right side of the street, 2 of them, the husband died in one, and the husband who was the final owner there passed away, both of them in the last 90 days. So of course, what have we seen? There's handymen there, there's workers,
Sure.
they're doing all this work. So the one got fixed up and the family's renting it out. The other one, the wife is still there, and we'll see what happens, hopefully a long time from now when she's gone. But you're not seeing as much turnover as expected. Certainly there is turnover, but not as much as expected. So I don't worry about it too much.
Well, and keep in mind that all these people aren't going to die on the same day at the same time in the same area. It's like, yes, it's going to happen, and but it's going to be gradual, at least for the foreseeable future. Sean has a good question. To pay off a 30-year mortgage quicker, is it better to do biweekly payments or one extra payment at the end of the year? And the answer is yes. Yes, whichever one is easier for you to do is the right answer. Biweekly payments, can be complicated in many ways. You can set them up typically with your accounts online to do it. Making one extra payment is probably the easiest way to do it. In my opinion,
it's easier than that, Jeb. Your account, your mortgage account has an online portal. So
Sure.
figure out that one payment and figure out 1/12 of it and add it each month, because there's an advantage to the biweekly in that the interest going forward is reduced by that small principal reduction. So doing it every 2 weeks versus once a month, there's not a huge advantage. Once a month.
Slow down, Mike Tyson.
Mike Tyson came in. It's going to do mortgages.
Maybe we'll get him on here. He's in Huntington occasionally.
I like it.
He's training over there at King still. Alfredo, what do you guys think about buying a trailer park? I think buying trailer park can be a fantastic idea, depending on what you're buying. And it's all about the land value and how much rents those things create. But if you can afford to do it, they can be cash cows.
Go look up Pace Morby's story. He has a video walking you through it, that someone got it under contract with seller financing. They couldn't figure out how to do it. They brought it to him. He gave him like 20 grand to go away. And he's got a trailer park in Yuma that's like 20,000 a month positive cash flow that he put nothing into with seller financing. So there is great possibilities and great potential, but please know what you're doing. Let's not do that as our first investment.
No, good stuff. All right, guys, we're there. We're there at the end of the show. Not a lot of questions. Not going to make you guys hang on. I'll mention the webinar that we recorded a couple of weeks ago for first-time home buyers, walking through that home buying process. It is on Spotify. It is on Apple. It's episode 169. Walks you through that entire process. Also on the Educated Home Buyer YouTube channel, which is up to 6,200 or so subscribers. So we appreciate you guys and the support on that as well. If you haven't checked it out, go do it. We recorded an episode today on home ownership and versus the stock market. We did basically housing market versus stock market. It's going to be posted next week, so make sure you check it out. But until next week, guys, make sure you buy right, you borrow smart, and you build wealth. Adios,
amigos.